All right, so these are the chapter 10 part 2 notes. There's really two big things being discussed in this section of notes. It's the capitalization of interest on loans, in particular interest that is incurred on loans during construction periods. So while I'm constructing an asset, that's when this actually becomes feasible. And then the second piece of it is R&D, how we treat R&D costs and how we treat R&D costs with respect to software. So first with interest, we can capitalize interest expense that's incurred during the construction of fixed assets. It's considered part of the cost of acquiring the asset and preparing it for its intended use. But we're only getting the interest expense on it. You know, if I borrow $8 million, sure, that $8 million is being spent on labor, materials, what have you, in constructing the asset. That will already go into it dollar for dollar as I spend money on worker salaries that are building the building. That increases the value of the building I'm building by $1 for every dollar I pay them. Every dollar I spend on all the raw materials, the overhead, everything that is being, being expensed and consumed to construct the building, all of that goes in there. But on top of that, the interest expense from that $8 million loan, or whatever size of the loan, can be considered for capitalization into the asset we're constructing. Even when we are not borrowing funds specifically for the purpose. So even if there's just existing debt, so even previously existing debt, the interest on those loans could be capitalized. So, the idea is that even if it's money from a prior period that we got from a loan, and it was used for other purposes, it still would, if we hadn't gotten that loan before, we would have had to use money that we might have now to have paid for those past things. And so basically money is fungible. It doesn't matter if I got the money and spent it 10 years ago. The fact that I got that money 10 years ago gives me more cash flow today to spend on this project. And so with that mindset that money is fungible, it can be exchanged. $1 yesterday, well, except for time value of money, $1 is just another dollar. It's okay for us to consider even non-specific loans. And like I mentioned, yes, we can capitalize interest on construction. So non-capitalized interest, right? We've seen this before with adjusting entries, debit interest expense, credit interest payable, the usual thing. Now, if we are capitalizing interest, then we would debit the building, right, for the interest instead of interest expense. The credit still goes to interest payable. It's still, that's still what we owe. We still owe money for interest. It's just that rather than classifying it as an expense on the income statement, we're putting it into an asset account for the time being. Ultimately, that interest will be depreciated over time because we're going to depreciate the building as we use it. And so we're not avoiding a recognition of the expense. We're just altering the timing of it. We're deferring the expense to future periods. Once we complete the construction project, then interest goes back to being recognized as normal. So what follows is a lot of, so it might not, I'm going to cover it, because we need a rough idea of what's going on, but it probably won't make a lot of sense until we start applying it to a couple examples. And then I would recommend, after you've worked through a couple of examples, to go back through and see if it makes more sense. It is definitely something that has a lot of, there's interest calculations, there's like weighted average expenditures, there's like what qualifies, what doesn't qualify. So it gets a little bit, there's a lot of moving pieces. So don't be afraid if you don't totally get it the first time through. It took me a couple of passes my first time. So we have to have an asset that qualifies. It has to be an extended time of construction, and it has to be intended for the enterprise's own use. So we're not constructing assets for sale. That does not qualify for interest capitalization. It has to be for our own use. It has to be a discrete project, which means that it's not something that we're going to finish within a week. That's not really a construction project. And it has to be something that we undertake, not under a regular course of business. Capitalization period. So the period that we can actually begin to capitalize interest, actual cash has to, expenditures have to be made, money paid to contractors, to employees, for materials, vendors bringing materials through. So we have to have some real cash flow, not just accruals. We can't just be like, oh, people work for us, we debit wage expense and credit wages payable. It has to be some real cash flow that is being spent. Real activities are necessary or are necessarily undertaken. So something has to have happened, i.e. we broke ground, right? We started digging the foundation. We laid we've started bringing in the trucks and delivering whatever we need, the materials to actually pour foundation, to build the structure, the scaffolding around the building as things are happening. And interest cost obviously has to be incurred. Like I said, we can either have specific debt that was directly associated to funding the project, or it could be debt that we already had outstanding. But these three things have to be all in play before interest can be capitalized. Very important to know how it qualifies, when we can start the capitalization process. If I've taken out a loan and I've broken ground, but I haven't paid anybody yet, doesn't matter. I can't capitalize interest until I write that first check, right? And of course, this ends when the building is complete, when it's ready to be used. And I keep saying building, but it could be something that's not actually a building. It could be a very intensive, huge piece of equipment that we're going to use for our company. So the amount to capitalize. Basically, we're limited by the total interest that are accruing from loans. And that makes sense. Once we've figured out all the interest that is accruing from loans, that's the total that I could ever think about capitalizing. And then we have to also, so against this, we're comparing the amount of construction costs that qualify for capitalization. So the lesser of these two is the maximum amount. It's either the amount of interest that loans are accruing, or it's the amount that I can actually qualify for capitalization. So if the costs that are qualifying for capitalization exceed the total interest expense, then we can only take the total interest expense. We're limited to that amount. If the costs that qualify for capitalization are less than the total interest expense, then we're okay. We can recognize this as capitalized. This portion, which is the remaining amount of interest expense, because we didn't get all of the interest expense with what qualifies this lesser amount, then this would be the interest expense we still recognize on the balance sheet. So to make this, when I set this up a while ago, I should have just put dollar values here. If this was like $10, this was say $6, then $4 would go to the income statement as interest expense. So we will have cases where we have theoretically $10 of interest expense. All of that would be interest expense if we weren't constructing an asset. But now only $6 is going to be capitalized because of that construction, and $4 will be expensed as usual as an other income expense item on the income statement. But if over here we have $10 of total interest expense, and I was actually had $12 of construction costs that qualified, well, then I'm still I'm relegated to this amount. I can only capitalize $10 because these exceed the maximum ceiling on what I can capitalize. So how do we calculate this? First, we have to calculate, in order to figure out what my qualifying expenditures are, I need to figure out what the weighted average expenditures are. This is to determine qualifying construction costs. In order to do that, you multiply each expenditure, each amount spent, by the amount of time that it can accrue any sort of interest. So it's a fraction of the construction period that we're looking at. And the construction period is just the number of months from the beginning to the end of the construction. Or if we're talking about more than one reporting period, it is at the beginning of construction to the end of this current reporting period. So if you think about it, what we need to, why we need to do this is, think if we were constructing something and we made a payment of $1 million on December 1st and a startup payment of $100,000 at the beginning of construction, January 1st. What was the average amount of expenditures that the company made during the year? Now, we can't just say, take these two and average them. It's 1.1 million. So they spent on average 550,000, because we really had only spent 100,000 during most of this period, right? Back on January 1st, we spent $100,000. Then all the way up to December, we had only spent $100,000. Then December rolls around and we have a huge $1 million payment, but we can't say that our average expenditures were $100,000. Just the simple average of those, $550,000 during the year. In this case, assuming that construction was going all year long, we would have $100,000 times 12 out of 12. And we would add that to $1 million times 1 out of 12, showing that, hey, this was something that we had spent, that had been spent for all 12 months. This, on the other hand, had only been spent for one of the 12 months. So then after we get those weightings, we sum them. And then for this case, of course, we would have 100,000 because we're multiplying it by 12 out of 12. This would be just 1 million divided by 12. Let me do the math for that real quick. Make sure I got the right number of zeros. Comes out to 83,333. So the average expenditures, the weighted average expenditures spent on this project during the year would be $183,333.33. But don't worry about the rounding, keep it there. After we get that, then we assign these expenditures to an interest rate, to some sort of debt. So there's a couple of ways that you can do it. We can assign this amount if there's actually two ways. There's called the specific method, and then I think the weighted average method. I forgot their names, but one means that with the specific borrowings method, you apply this to the loan that you took out specifically to fund the project. And then if there's anything left over, you apply it to the loans that are not specifically borrowed to fund the project. If it's the weighted average method, then you just weight the loans that you have, whether they're specific or non-specific, you weight them all together and then apply this to the weighted average of those loans. And then it just goes through saying, basically, if you run out of money to capitalize, then you're at your maximum amount of capitalization. If you don't run out of money to capitalize, you can basically capitalize all the interest expense. But again, the words get a little confusing until you work through a couple of examples, and then they'll probably make more sense to you. So I want to jump into this example with the interest capitalization. We got a new building costing $2 million in total. The construction began at April 1st, 2006 with the following schedule of expenditures: April 1st, 500, June 1st, 700, 600, 200. The construction was complete at the end of 2006. So we have the construction project beginning April 1st, ending December 31st of 2006. We don't have to worry about going across a reporting period, which is nice, makes it a little bit more simple. So on April 1st, we spent $500,000. And then on December 31st, we have construction ending, which means that in this time period, we have 9 months. So the construction period lasted 9 months. And that's going to be important when I look at my weighted average annual weighted average expenditures. I have a payment on April 1st for $500,000. And that will get the full period. And remember, I'm weighting it over 9 months because that is the construction period. So this gets 9 of 9. It doesn't really matter with the first term, but it matters thereafter. If the first one is always spent on the beginning of the construction, it's always going to be 100%. So that's why I was like, it doesn't matter if it's 9 of 9 or 12 of 12, it's still going to give you 100%. But once you start moving through the months, it changes that a bit. So then we're 2 months in, 6/1. On June 1st, we spent $700,000. So if that was spent on June 1st, then you would have June to December 31st, which is 7 months. Be very careful. Again, remember, we're talking about the 1st of June. And so that means that it's counted in. You can't just do 12 minus 6, because if you take 12 minus 6, you're getting rid of the month of June. You're subtracting 6 from 12. So month number 6 goes with it. That's just like one of the most frequently missed things I see when I'm grading exams here. So 700,000 times 7 divided by 9 gives me 5,444 and 444, and I'll take it to the dollar. Won't go any further than that. On 8/1 August, you have 5 months left. 600,000 was spent. And again, remember, I'm taking all of these out of 9 because my construction period is 9 months. So 600 times 5 divided by 9. A lot of repeating digits here. 3, 3, 3, 3, 3, 3, 3. We got 1231. This was spent on the very last day of construction. It was not outstanding for any appreciable amount of time. So it's 0.9. If it was spent on December 1st, it would get 1/9. But it wasn't, so it gets no weighting in our average expenditures. We add these up then in order to get the total weighted average expenditures for the construction period. So we got 500 plus 544.444 plus 333.333. That gives me 1,377,777. That is my WAE. Now, after we have that, these are the expenditures that qualify for interest capitalization. Now I take it and assign the interest that I want to. It says, suppose the company borrowed 800 specifically for this project at 7% on April 1st. The company has other non-specific borrowings of $1 million at a weighted average interest rate of 8%. So if we're using the specific method, then we would apply the 800,000 first. We would take, all right, we got this much that qualifies for expenditures. And we're going to take 800,000 of that. And that amount is going to be assigned that 7% interest rate. Now remember, this is an annual number or an annual rate. So we can't capitalize the full 7% because construction started April 1st and we only took this loan out on April 1st. So for any loan borrowed, our ability to capitalize interest would be 9/12 of that amount. And it's 12ths because this is an annual rate. All the time I see people mix up the denominator here with the denominator here. This is 12, always 12, because we're dividing it into the annual rate to get a per month and then multiplying it by the number of months we want. This is going to change with the amount of the construction during the period. So the next piece, we got the 800 assigned, but we still have, even after the 800, $577,777 that qualifies for capitalization. Do I have enough debt to capitalize that? Well, yeah, I still got $1 million left. So all of this, I can't capitalize $1 million, but I can capitalize up to the amount that qualifies, the expenditures that qualify for capitalization. So if that amount had a weighted average of 8% as its interest rate, well, then I can also capitalize that amount. In this case, it was the weighted average expenditures that limited the interest capitalization. Because once those ran out, I still had more debt. I still have interest. The interest that's accruing on the remaining amount, 1 million minus that amount, that's still being expensed on the income statement. And so I take this and it also apply 9/12. This debt had been outstanding all year, but because we're limited to the construction period, we can only count 9 months of it. So we work out this math we take the 800,000, we apply the 7%, and we multiply that by 9 divided by 12, and we get 42,000. And for the bottom one, 577, 777, multiply that by 8%, and 9 twelfths. And let me do that one more time. So now it's a weird number, 34,000. Yep. And 62 cents, if we're being exact. So this amount of interest can be capitalized from that loan. This amount of interest can be capitalized from that loan. So in total, then we have $76,666.62. This is the amount of interest capitalized. Now, this is a specific method, like I mentioned. That would be the amount of interest that's capitalized. We would also have interest that was unable to be capitalized. So, for example, and just to flesh out what the journal entry would look like precisely here, I do want to look at that. This loan, the 7% was borrowed on April 1st. The non-specific borrowings, 1 million. We'll assume that this was outstanding. I don't say it here, but we'll assume it was outstanding the whole year. Then the total interest expense without any capitalization, assuming we didn't build anything, we just borrowed these two items, we would have had 800,000 times 7% times 9 out of 12, because we took it out on April 1st. For the 1 million, we'd have had the 1 million at 8%. And if it was outstanding the entire year, then we would just do 12 out of 12, right? The full 8%. So that would give me, I've already done the 800,000, 7% at 9 to 12. It was totally capitalized, but we're going to write it over here as well, 42,000. This loan would have generated, so that would be $80,000 of interest. The interest for both of these guys together would have been $122,000. That would have been the total interest expense I would have recognized during this year if I had not one construction job going. Because I was able to capitalize an amount of that, right? This is just the portion that I was able to capitalize of this total amount. This goes into my building, we'll call it. This is my asset under construction. And I'll just round this up so I don't need to write 72 cents again. 76,667. The interest expense that would still be recognized is the difference between these two, right? If this is everything I would have recognized without construction, but this much got capitalized, then the amount of expense I recognize is simply equal to the difference between those. So let me take the difference real quick. 122 comes out to 45,333. And the interest payable, because all of that is interest, even though I classified some of it as going into a building account and some of it as going to the income statement as interest expense, all of it is still interest payable. And so I would still record interest payable of $122,000. But that is, why some of it's moving one way and then some of it's moving another way. Now, I kept mentioning the specific method. If we were doing the weighted average method, this is set up really nicely for me to invoke the weighted average, because the weighted average says, all right, don't worry about applying the specific borrowing first, just take the average of all your borrowings. What is their average interest rate? To figure out the average interest rate of all the borrowings, we know that separately, when we total them, they come up to $122,000 of interest expense. And basically, we're saying interest expense is equal to the principals times a weighted average interest. Sorry, that's not on the page. So if this is their total interest expense, I divide it by their total principal. And what I'm left with is the weighted average interest expense. And their principals will be 801 million. So that's 1,800,000, generating $122,000 interest expense. And do that math real quick. 122 divided by 1,800 is I did something wrong here. Give me a moment. No, that is right. Okay. Then I erased it. 122 divided by 1,800 is 6.78%. I was worried for a second because I was coming up with a weighted average that was less than either of these interests. But then I realized that since this is only 3/4 of the year, that actually weights this lower, and so it could be less than. Anyway, all right, so this is the amount of our average for both of them, our weighted average interest. Then it kind of simplifies things, because we don't have to do, when we're doing the weighted average method, we don't have to go to the specific first and apply that rate, then the non-specific, then apply that rate. We would just take the total amount that qualified for capitalization, 1,377,777, and multiply it by this amount. We could only multiply it by that amount for 9 out of 12 months because of the limit on the capitalization period, because of the limit in the construction. And when I get that amount, do the math behind that interest calculation, 1,377,777 times 0.0678 times 9 divided by 12 gives me a slightly different amount of interest to capitalize. In this case, I get $70,060. It was 96 cents, but I rounded it to 60. That would be the amount of interest capitalized using the weighted average method. But companies can choose either one, specific or weighted average. All right. Let's look at another scenario to this. In scenario 2, suppose that instead of having $1 million of non-specific borrowings, the company only had 200,000. So instead of having this 1 million, they only had 200,000. Well, we already know that they had 1,377,777 qualify for capitalization. None of the expenditures changed. So that's still the case. The only thing that changes then, we still do have the specific loan of 800,000. So that's still there. So all of that work still tracks into this next example. The only thing that changes now is we have 577,000 remaining, but we only have $200,000 of that non-specific debt. Before, we had more than enough to take care of every dollar that qualified. Now we don't. So we still have the 800 times the 7% times 9 out of 12, and that's still 42,000. But I'm limited now by the expenditures, or I'm not by the expenditures, by the amount of debt I have. Only 200,000 of that is outstanding, 8% times 9 out of 12. And that is going to give me a slightly different answer. That's 16. Actually, I can do that in my head. So yeah, that's 16,000. And then 3/4 of 16,000 is 12,000. So that would give me $54,000 of interest capitalized. Now, that doesn't mean that we were able to capitalize it all, because there's still some interest. Where's their interest, you might ask? I used all 200,000. You actually didn't. If this had been outstanding for the entire year, then there's 3 months of interest prior to the beginning of our construction period that was not attended to. So if you look at it, and it's always easiest, in my opinion, to figure out the total interest expense of everything, because you're going to use that if there's any question about like how much interest was actually expensed, i.e. in this case 45,333. It is so helpful to get the total, and then you can just subtract off the amount you capitalized, and you have your answer right there. Instead of 100,000, this is just 200,000, and it's 8%, and it is for all 12 months because it's outstanding for the entire year. So that would be 16,000. We actually have $58,000 of total interest. We capitalize 54,000. So in this case, I would have the building being capitalized by the interest of 54,000, but there's still $4,000 of interest that will end up as interest expense. And then that becomes interest payable. So that's that. If construction continues past the end of the reporting period. So for example, in this example, if it had not ended at the end of the year, but maybe ended 3 months into the next year, then you carry over all costs that have been capitalized, including interest costs. So all costs that have been capitalized would just be the balance of the construction asset account. They would all be considered an expenditure made at the beginning of the next year. So whatever is the balance of the construction asset, and that includes not just the interest we capitalized in the prior year, but all money that we paid, all the materials we bought, everything that was spent on this project, it is an expenditure that is fully weighted at the beginning of the next period. And that's how you treat that. There's some special issues. If we have interest costs incurred to purchase land that's going to be used for our building site, then that's going to be the building's cost, capitalize that to the cost of the building. Do not capitalize to land. You want to be careful about capitalizing things to the land account, because then it gets locked in land. Remember, we don't depreciate land, so we can't get it out of there. Interest costs incurred on land being developed from lot sales are part of the land's cost included in inventory. This is something where if we're selling it, we can consider that for capitalization if we're developing for a sale, but not if we're going to keep it and use it. And then the interest revenue, if there's any interest revenue, we don't net that against our interest expense when we're considering what can be capitalized. So we determine full interest expense, not net interest expense. A lot of companies have offsetting investments that will give me interest expense net. You don't use interest expense net, which is interest expense less interest revenue. You want to use total interest expense. These are just kind of little things. I wouldn't worry about these so much. Use total interest expense. Wouldn't worry about these items so much. They're very particular to certain types of practice, but do understand how to capitalize interest like we did in the prior example. Some random costs that are business or product startup costs, these are not capitalized. These are their own special brand of expense. So you could, expense debit startup costs, organization costs. These are just two types of expense. It could be the reason why I just talk about these here, and that your text does as well, is that, you could think of it as this is kind of part of getting something ready, getting an asset ready, for example, but they are specific costs. If we're talking about a new product line, a business segment, a new location, they're expense, not capitalized. They're a little too vague, a little too all over the place, right? Like we're opening up a new store, there's marketing costs, there's advertisement, there's all kinds of construction and moving costs. All of that is not debited to a building account, right? This is expenses that are related to a multitude of assets that are going to be sold there. And so it's harder to assign those to, for example, like one piece of equipment that I'm buying, that I'm shipping to my place of business and training employees and building special foundations for. So that's those two items. Just understand that that's where they go. R&D, of course, is where I want to turn my attention last in this